Hello, everyone. So we know the stock market is in a state of turmoil at this point of time, and Nifty is experiencing a relentless fall. And over the last six trading session, if you see, Nifty has been consistently dropping, and currently it's trading below not only 20-day moving average, not even 100-day, and it is touching the 200-day simple moving average actually. So the big question on everyone's mind is, will this downtrend continue, and where might be the bottom be? So in today's video, we will be analyzing the key trends, historical corrections, and the valuation metrics like PE ratio. We will also explore whether Nifty's decline presents a buying opportunity or if caution is the smarter approach. So if you are looking to navigate these uncertain time, you can watch the video completely. So there are speculations that Nifty may continue falling for another 10%. Okay, anyway, let's try to understand this. As of November 14, see, Nifty have fallen more than 10% from its recent highs from 26,000, which was touched in the last couple of months back. And now it is trading at around 23,500 level. So experts are predicting even an additional 10% decline by the end of this year, by December. So whether this forecast is realistic or not, is a big question. And to answer this, we must examine the past market corrections. For example, if you see previously, we have seen this kind of correction post-COVID time was during December to March, where FII selling was again very high. December 2022 to March 2023, this 4 months, like Nifty experienced a similar drop, around 11% drop, which was again fueled by heavy FII selling at that point of time. But the market bounced back sharply in the months that followed due to significant buying activity by FIIs. So FIIs selling was there, but significant buying was there from FIIs immediately after that. But now the situation is slightly different. We'll look into that. Now, during that December 2022 correction, Nifty PE ratio fell from 22 level, 22.5 to around 20. And that made a strong support level. So a similar trend was observed during October 2021 to June 2022 correction also. So again, at that point of time, Nifty PE ratio dropped from 28 level to around 19-20. And from there, market actually reversed. So my point is, try to understand PE ratio. So historically, a PE ratio of 20 has been critical turning point for Nifty, and that is signaling an attractive valuation and sparking fresh buying interest. So we have discussed the historic correction post-COVID. So we have discussed from December 2022 and October 2021 correction, both these situations, PE ratio, when it came to 20 level, Nifty bounced back. So from that, we are analyzing and we are understanding that PE ratio of 20 is critical for Nifty. Now let's look at the current market sentiment. So in October alone, this last month alone, FII sold staggering 1.14 lakh crore, and selling trend has continued in November also. And this has created immense pressure on Nifty. So we can see whether when the PE ratio approaches to 20, so if PE ratio approach to 20, I can say Nifty at around 21,700 level as per the current EPS data. If Nifty fall to 21,700 level, that's when PE ratio become 20. So this level is significant because Nifty have historically found strong support here also. You can check that, and you can see Nifty is bouncing back multiple times in the past from this level. So that level is again very crucial. Now let's look at the global factors which is impacting market. Guys, if you look at the US 10-year Treasury bond, it is yielding currently a very good return, very good, at a high 4.46%. Such elevated yields often, deter FIIs from investing in emerging markets like India, as they opt for faster, higher yielding instruments. So when you get, a US bond without much risk or any risk, that 4.5%, what's the point in you bringing your money here and you are investing here? That is actually not required, right? So that is something which again they will consider, of course. So here emerging market like India is actually risky for them to invest, considering that rupee depreciation also. So that is again very much you need to take it into consideration, right? So when rupee depreciate, you will be getting in rupee, correct? So when you are bringing and when you are selling the shares, and if you want to take it back, when you're selling, you will be getting in terms of rupee. And when you convert that, earlier when you were coming, you need to pay, you will be getting 100, let's say 100 rupee. Imagine 100 rupee. But now rupee depreciation, so you need to pay 102. I'm talking in terms of percentage. So you need to pay 102 to get $1. Okay, so that is again contributing, and that is actually leading to a loss also. So when you were coming with a dollar at that time, let's say you were getting 100 that time, but now because rupee depreciated, if you need to get that $1 to take back, you need to pay back 1 or 2 rupees. If you take the actual value of dollar, let's say 84. Suppose they when they pumped in money at that point of time, let's say it's 84. Now let's say if it is 87, so that percentage difference is also very important. So there is no such risk if you are investing in bonds in US, right? So that's why they may prefer that, because that is giving very good return, right? So this could further delay that FII return to the market, and that can maintain the downward pressure on Nifty. Like we have seen before, whenever there was a sharp decline like this, the FIIs again bought it. But now we are not seeing that trend, and it is unlikely that you will see that trend back soon. Okay, it may take some time. Let's look at the domestic factors. Now, domestically, the Indian government capital expenditure has been slower than expected. So by the halfway mark of this financial fiscal year, only 37% of the 11.1 trillion budget has been spent. So, however, if you see, the good news is that the government may accelerate spending in the next 6 months and potentially boosting economic activities, and that can improve the market sentiment in the next 6 months. Now, let's try to understand some stock specific opportunities. Guys, despite this bearish sentiments, and this correction can also present opportunities for smart investors. So the key factor to consider will include the management quality. So when you are trying to invest in any stocks, you need to look at certain things, right? Sector outlook, which sector you are going to do. For example, even when you consider this rupee depreciation aspect, so import will become costlier, export will become better, and more exports will be there. So whenever you are exporting, you are earning in terms of dollar. So you need to think which sector is going to benefit because of rupee depreciation. IT sector. So that's how you need to understand the sector outlook also, the management quality of that company, and the earning potential, the growth and everything, revenue and everything. So additionally, you also focus on stocks that consistently hold strong support levels during the market corrections. That can also provide you an edge, and all these can be slowly added, you can add to your portfolio. So for example, like stocks that found support during previous market lows on dates like June 4, August 5, October 28 may worth accumulating at those levels. So I hope the point is very clear. Now, how can you strategize in this market? See, market may remain volatile, market may fall further also, but you need to maintain that discipline, and that approach is very crucial. So look for fundamentally strong companies, analyze historic support levels, and analyze the fundamentals, and consider accumulating stocks gradually, step by step. I mean, add in different phases, whether it is going down or even if it is going up, add in different phases rather than making a lump sum investment, because as the experts suggest, it can further fall 10%. Nobody knows that. And still, if we need to approach to that PE ratio of 20 that we have discussed, it have to come to 21,720 also. So there is a possibility that it can further fall. So what we do is we need to, accumulate gradually. Whether from here market is picking up or from here market is going to drop further another 10%, still we are going to add gradually. So remember, timing the absolute bottom is not possible, and it's risky and it's challenging. You may miss the opportunity, or you may be taking a biggest risk also if you're thinking that this is the bottom. So focus on building a portfolio with a strong risk reward ratio. So that's what I want to tell you. And see, again, of course, the current market is bearish, but history suggests that every correction eventually lead to a recovery, and this is a 10% correction. So if we need to add some into our portfolio, there's a best time. I am adding into my portfolio certain stocks that I used to keep in my portfolio. So understanding valuation metrics like PE ratio, monitoring the global and domestic factors, and adopting to stock specific approach can help you to navigate these uncertain times. So that's all what I want to discuss with you, and I hope you understood something from the discussion, and thank you so much for watching. See you guys in the next video.